As an investor, it's necessary you know precisely how to evaluate dividend sustainability, how to assess a company's dividend yield. So in this case, you consider, you know, very important actually. You consider number one, the payout ratio. You consider the company's dividend payout ratio. And the payout ratio is the percentage of a company's earning paid out as dividends. That's if the company's earning is let's say $10 billion, all right, and the company pays $1 billion as dividends. So in that case, the payout ratio is 10%. So a lower ratio suggests the company is retaining enough earnings to reinvest in the business, making it more likely, to sustain that tempo, more likely to sustain its dividends. And you also consider what is called, ideal range. The ideal range. So a payout ratio, under 60% is often considered sustainable, but it depends on the company industry as well as the growth stage. Number two, earning stability. Earning stability. How stable is the company's earnings? So evaluating the stability and consistency of earnings over time is important. How stable is the earning, over a range of time? A company with an unpredictable or declining earnings might struggle to maintain its dividend payments. If the earning graph is going down, the company may find it very difficult to keep on paying dividends. They may introduce dividend cuts. So you equally, check for consistency. You check for consistency. Look for a history of stable or growing profits, especially during economic downturn. Is the company profit stable? Is it growing? Particularly in a down, in a down economy, when the economy is not performing very well. Number three, cash flow. Cash flow. Dividends are paid from a company's cash flow, not just its accounting profits. A company may record accounting profits but may not have a corresponding cash flow. These are sometimes two different factors altogether. So a company with strong free cash flow is better positioned to maintain its dividend payments. So we consider free cash flow. Free cash flow. Ensure the company's free cash flow, that's the cash it generates after expenses and investments. Ensure that it comfortably exceeds its dividend payouts. In other words, it has enough cash on ground to be able to pay out dividends. Number four, you look at the debt level. Debt levels. In Nigeria, we call it debt. We call it debt level. Debt level. It's all right. So higher level of debt, can pressure a company's ability to pay dividends, especially if interest payment becomes burdensome. Instead of paying dividends, they will channel that money into servicing their debts. The company will channel the cash into, debt servicing. So companies with low or manageable debt are more likely to sustain dividend payments. So we will not neglect debt to equity ratio. consider debt to equity ratio. So a lower debt to equity ratio often signals a more financially stable company. It has more equity and little debt. So debt to equity ratio, right? So the higher the equity, the better. The lower the debts, the better. Number 5 is a dividend history. Dividend history. So examine the company's track record of paying dividends. You fast track backward and analyze and research its dividend dividend paying history. So companies with a long history of consistent or growing dividends are more likely to continue the trend. That's why you have companies they call dividend aristocrats. They've been paying dividends for many decades. Dividend kings or dividend aristocrats. So in this case, you look at dividend growth. Look for companies that not only pay dividends, but also increase them regularly, not just in the payments, all right? But does it increase over the years? So you look out for dividends and dividend growth. Please subscribe to this channel if you've not done that and like this video. It will encourage me a lot. Number 6, industry and economic condition. Industry and economic conditions. Consider the broader industry and economic environment. The companies in a cyclical or volatile, sector may be less, predictable when it comes to sustained dividends. It is cyclical. You cannot really predict whether they will pay or not. It's a factor you must not neglect. So in this case, you look at resilience. Ensure the company operates in an industry with stable demands or has a competitive edge that supports long-term dividend sustainability. Number 7, management and governance. You look at the company management, the executive, the board of directors, the top level managers. So strong shareholder-friendly management is crucial, very important. That is, the interest of management is aligned with interest of shareholders. So companies with a clear, well-communicated dividend policy and a responsible management are more likely to maintain dividend payments than those that don't really have this this arrangement on ground. So in that case, we look at we consider management commitment. You look for companies where management has publicly committed to maintaining or growing dividends. In the case where the management come out to publicly guarantee that they will keep on paying dividends, that's good news. It's melodious to the ears. All things being equal, you have a regular income. Number 8, dividend coverage ratio. Dividend coverage ratio. This ratio compares earning or free cash flow to dividend payments. What is the earning? What is the free cash flow? Can it cover the dividends, payouts? So a higher coverage ratio indicates a safer, more sustainable dividends. So what is the ideal ratio? A coverage ratio of 1.5 to 2 times the dividend payment is generally considered healthy. 1.5 to 2 times. If the dividend is, let's say, $1 billion, and the company can afford 2 billion or 1.5 billion, in that case, they can very easily cover the dividends. You can do it, in a sustainable fashion. By analyzing these factors, investors can assess whether a company's dividend yield, is sustainable, in helping to ensure that they are making a sound investment decision. So focus on sustainability is very, very not just payment, but how sustainable is that payment?